This year so far has been dominated by multiple global and domestic events like US fiscal concerns, tariff tantrums, India growth concerns, persistent FIIs outflows, mixed union budget and recent India-Pak conflict, etc. These events-related uncertainty resulted into heightened volatility across world markets and asset classes. However, markets have seen sharp recovery in the last 1 month, but some ground is still left to cover to reach new highs. MSCI World Index is approximately 3% away from previous highs, while key US and Indian equity indices are trading approximately 5 to 12% lower than ATH. Current US macroeconomic scenario is mixed, in terms of slower GDP growth, sticky inflation, high fiscal deficit and overall debt with rising rates. Also, US bond market is bracing for an extraordinary supply challenge as approximately $9.2 trillion debt is maturing in 2025. Amid all these, the recent Federal Open Market Committee stance reflected caution, underlining the complexity of the situation. In comparison, India appears relatively well positioned. Key indicators such as falling 10-year yields, relatively stable INR, contained inflation, and a consistent fiscal discipline support a constructive outlook. Although there has been some slowdown concerns, but record high GST collection in April with strong YOY growth of 12.6%, upward trending manufacturing PMI, robust export numbers are indicating towards pickup in growth as well. FII flows have turned net positive for 2 consecutive months, reflecting renewed investor confidence. Nevertheless, recent geopolitical tensions with Pakistan have introduced a fresh element of risk, serving as a reminder that uncertainties have not been entirely dispelled. With most of the events-led volatility behind us or largely being factored in by the markets, the focus should shift from events to earnings. Q for earnings results declared till now are also suggesting improvement in the earnings. We expect Nifty Index EPS to deliver 14% CAGR over the next 2 years. Temperature Gauge Index remains in the fair value zone. Global concerns of US tariff war and slower US growth, which added uncertainties in equity market across the globe, have receded for a while. As these concerns abated, Indian markets started factoring in the improving domestic macros like stabilizing yields, rupee appreciation, declining inflation, falling crude and optimism around domestic earnings. This combined with the return of foreign investors led to a sharp recovery in April 2025 from the lows. However, India-Pakistan military escalation may add a layer of uncertainty until more clarity emerges, leading to a volatile market. Although, broadly, the overall outlook remains stable due to strong economic fundamentals, stable government and healthy corporate balance sheet and rising interest in Indian equity market. The corrections have made valuation of large caps, Nifty 50, around the 10-year average on 1-year forward basis, while mid and small cap indices still trading at premium with pockets of opportunities seem to have emerged. Considering the recent corrections, if equity allocation is lower than desired levels, investors may increase allocation by implementing a lump sum investment strategy for hybrid, large cap and flexi cap and staggered approach for mid and small cap over the next 2 to 3 months, with accelerated deployment in the event of a meaningful correction. In fixed income, benign inflationary trend and slowdown concerns aided RBI to shift focus on economic growth. Indian 10-year GSEC yield has been stable and gradually declining on back of favorable demand-supply dynamics and falling inflation. Measures by RBI like OMO purchases, term repo auctions and US dollar to Indian rupee swaps, etc. Actions by RBI on rate cuts and liquidity are likely to result into steepening in yield curve. We recommend fixed income portfolio to be overweight on accrual strategies. Duration at the current levels can be used as an opportunity to exit. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. In VEETs and select NCDs, 30% to 35% may be invested in performing credit strategies, NCDs, and in VEETs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long for short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed-income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. While gold benefited from global uncertainty and touched all-time highs in April, it now appears stretched as the uncertainty has subsided. We continue to remain neutral on gold from asset allocation perspective.